It's time for Yahoo Finance's Market Minute. Stocks moving to the upside, looking to achieve their third day of gains. We did see a dip in major averages earlier in the morning after consumer confidence data came in below expectations. Oklo shares sinking after reporting a wider than expected annual loss and guiding for significant expenses and losses going forward. The company paring back yesterday's double-digit gains following progress on its application with the U.S. Nuclear Regulatory Commission. Cloudflare shares getting a boost from a double upgrade at Bank of America. The analyst raising Cloudflare to a buy from underperformed, citing significant growth potential in AI and network security. And Trump Media shares moving higher on a partnership with Crypto.com to launch a series of ETFs and related products. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. And on today's show, Wall Street is awaiting Trump's, quote, Liberation Day on April 2nd, where he is expected to put in place reciprocal tariffs. We'll talk about the impact tariffs could have on consumers and the products that we all buy. And President Trump's nominee to run the Social Security Administration is in the Senate hot seat today. We'll discuss where he stands on policies that can impact your retirement. Plus, all this week, Wealth will be discussing spring cleaning your finances. We'll dig into different areas of your financial life, your budget, your investments, your debt strategies, in order to get you on a good financial path for the rest of the year. So we've got all that and much more coming up during today. But first, as we always do, let's take a look at some of the market action. We're 90 minutes into the trading day. You've got green across the screen right now. The Dow Jones Industrial Average, fractional gains as they may be, it's up by about 0.2%. About the same for the S&P 500. That's up roughly 0.3%. We'll be generous and round that off too. And the Nasdaq Composite up 0.4%. Stocks edging higher following yesterday's rally. This as consumer confidence falls to the lowest level in 4 years. Joining me now, we've got James Reagan, who is D.A. Davidson, Director of Wealth Management Research. Great to have you here with us. You're watching consumer discretionary in that sector. You say it's an attractive play for patient investors right now. How patient do I need to be?
Well, not too patient. We've seen the sector really underperform this year. It's been, down on an equal weight basis and, really due to concerns about consumer spending and where the economy is coming in. And I think that started in January when we had a very weak consumer data, but we do expect it to improve from here. And so there's just been kind of an avoidance of the sector, a lot of selling. So we're seeing much cheaper valuations. There could be some more volatility ahead, but we think investors that are looking out over the course of the year can find some pretty good values now in stocks across the consumer space, whether it's in retail or apparel, some of the leisure stocks and so forth.
And so as we're thinking about all this, James, and one of the major things that investors have been navigating with the most recent volatility is just what the real play out of these reciprocal tariffs could look like. How are you factoring that into your own investment strategy and thesis right now?
Well, the threat of tariffs has really weighed on consumer confidence. So we've seen the confidence come in weak, and where that really rolled over was when we saw the impact of the tariffs on the import data from January, and so the GDP trackers kind of turned negative. And so, it's a risk to the market that the tariffs will weigh heavily and cause some disruptions to the supply chain. We're still in the camp that there's trade negotiations ahead. We think there's going to be a mix of some tariffs sticking and then some tariffs being relegated to some kind of a trade deal. So we know that the president wants to see investment in the U.S., wants to see markets opened up to U.S. companies a little bit more. So we think that this is a key week leading into the tariff announcement next week, that if we are going to see some trade deals, we'd like to see some of them happen before those tariffs get announced.
Yeah, certainly. And so as you were running through some of the areas of consumer discretionary and what makes that trade, it also comes back to what we're seeing right now with consumer confidence too, and where there is some impact, some cracks in how consumers are thinking about the overall vibe right now, and especially as it comes back to the employment data as well and those prospects. So as you're continuing to get future economic data readings, what is the core economic data reading that you're looking to give even further of evidence of how the consumer is thinking right now?
Well, certainly the labor data is going to be key. We'll have jobs reports coming out next week. There's some concern that maybe some of the government layoffs will start to hit the headline jobs data. So we'll be looking below the line a little bit to see kind of how jobs growth is going out through the private economy. So I think that's key in the analysis. And then also, we'll look to the retail sales. I think there's still a couple weeks out before we'll get the March retail sales reading. We've known that the low income consumer has been under some pressure over the last couple of quarters. And it's been more of the high income consumers that are generating the spending. I think that's where the consumer confidence weakness comes into play. When the market was at its lows, we were a little more concerned about a wealth effect, reverse wealth effect, maybe limiting some of the higher end spending if consumers delay those purchases. But now with the market coming off the lows a bit, that maybe that's less of a concern. But I think it's really going to be the jobs data that we'll focus on the most over the next couple of weeks.
Yeah, certainly. Just lastly, while we have you here, as investors look for clues as to when they can really sense that risk is back on, risk is back in vogue, if you will, what are some of the clues that they should look to within the market and some of the larger inputs that they should be tracking?
I mean, it's going to be tough. I think the market is very sensitive to surprises still on the positive and on the negative side. I think the market sell-off has been a growth scare, so a fear that maybe we go into a recession, which we don't think is likely at all at this point, and a fear that the earnings erosion, starts to happen a bit. So I think at this point, though, our view is that we're going to see, a little lower than trend GDP growth this year, but still stay very positive, and maybe some vulnerability to the earnings numbers. So, the next earnings read that we'll get really will start here in a few weeks when the first quarter earnings start to be reported. And so that's a clue that if we see stronger than expected earnings and then decent guidance for the year, I think that's maybe a little more of a challenge. That could get us more to a risk back on environment. But absent that, I think we can probably expect some more volatility along the way.
James, thanks so much for joining us and taking the time.
All right. Thank you, Brad.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. And first up, Carvana getting an upgrade to overweight from equal weight at Morgan Stanley. The firm saying the recent pullback is a buying opportunity. The analyst lifting the price target to $280 a share from $260. That's 31% upside from the stock's last close. The firm noting Carvana has demonstrated execution with profitable growth and addressed leverage concerns. The analyst also saying his recent tour to a Florida facility underscored the company's competitive advantages with vertical integration and scale. Shares of Carvana are higher. Next, Mobileye is rising on a partnership with Volkswagen, VW. Volkswagen is working with the French auto supplier Valeo and Mobileye to upgrade the advanced driver assistance systems up to level 2+. So at that level, you essentially get things like automatic braking and adaptive control for cruise control. A driver's attention is still required 100% of the time, we should note. Bloomberg Intelligence says the deal could, quote, drive incremental revenue growth. And finally here, energy giant Shell is vowing to boost shareholder returns by doubling down on its liquefied natural gas business. In an announcement ahead of the company's capital markets day, Shell said it would expand liquefied natural gas sales by 4 to 5% annually until 2030. This will help return cash to investors via share buybacks. Wall Street is bracing for President Trump's, quote, Liberation Day on April 2nd, where he's expected to put in place reciprocal tariffs to try and even the score between the duties charged by the U.S. versus its trading partners. But many companies are currently worried about what tariffs will do to an already choosy consumer. Here with more, we've got Yahoo Finance senior reporter Brooke DePalma. Hey, bro.
Consumers are expected to feel the brunt of tariffs. According to a recent report from PwC, the annual total tariff impact for the consumer products industry would increase to $134 billion. That's up from $27 billion per year, hitting all types of goods, ranging from apparel to fruits to vegetables, all the way to your cleaning products. This earnings season, we heard from various consumer-facing companies, including the likes of Walmart, all the way to McDonald's, about how the consumer is holding up in this environment. Sneaker giant Nike warned the impact of tariffs on imports from China and Mexico will take a toll on its fourth quarter gross margins. General Mills CEO Jeff Harmening cautioned investors that consumer behavior hasn't gotten better.
Coming into this year, we thought the consumer environment would improve as the year got on, and that hasn't really been the case. And consumers are still seeking value as much or more than they had, when our fiscal year began. And the situation we find ourselves in is different than we thought the one coming into the year. And so consumers are seeking value. We see that in the categories they're pursuing in many, many ways.
Meanwhile, Walmart was among the first to share how it plans to manage through tariffs. Walmart CFO John David Rainey told Yahoo Finance it's not even immune to tariffs, even though 2/3 of its goods are produced, assembled, or grown here in the U.S. The brand is currently working with suppliers, particularly in China, to keep prices low for customers. Department stores Macy's and Kohl's, both of which are in the midst of turnaround strategies themselves, both lowered their outlook, citing external uncertainties of the macro environment on both the business itself and its consumers. Meanwhile, Dollar Tree, which has a majority of its sales come from a household income of less than $35,000, said it's not expecting any improvement either. Here's what the CEO said on the call.
With regards to current tariffs that have been announced on products that we sell, we believe we are well positioned to mitigate the impact in 2025. We were able to successfully mitigate the tariff impact in 2018 and 2019, though we did take retail price increases in some instances, along with others across the industry. Given the already stressed financial condition of our core customer, we are closely monitoring these and any other potential economic headwinds, including any changes to government entitlement programs.
And lastly, fast food. Shares of McDonald's and Yum Brands have actually slightly outperformed the S&P 500 as investors believe consumers will turn to value meals. Taco Bell shared its plans to increase its value mix from 13% to 18% at its recent investor day.
Brooke, thanks so much for breaking this all down. Appreciate it. 23andMe, the genetic information company that can tell you about your ancestry through a saliva test, has filed for bankruptcy. And while the company says there will be no changes to the way that your data is protected, you may want to take action or risk your information falling into someone else's ownership. California's Attorney General has issued a consumer alert urging all customers to delete their information. Here are the steps to delete your account. Log into your 23andMe account on their website. Go to your profile and tap settings. Scroll down to a section labeled 23andMe data at the bottom of the page. That's where that's located. You can click view next to 23andMe data. And if you want a copy of your generic data, you can choose the option to download it to your device. Then scroll to delete data in that section. Click permanently delete data, and to confirm this request, 23andMe will send you an email. You can follow the link in the email to confirm the deletion request. You can also choose to have the company destroy your sample. Log into your account, go to settings, then hit preferences, and change from there. Navigate to the research and product consents section to revoke permission for your data to be used for research. Coming up, President Trump's nominee to run Social Security is testifying in front of the Senate Finance Committee about his plans for the agency. We'll break it down. Plus, Bitcoin hasn't traded above 90,000 since March 7th. We discuss what's next for the cryptocurrency. That's after the break.
What role will privatizing Social Security, bringing in private equity and tech people, and giving Elon Musk and his little crowd a role have in all of that?
I've never thought about privatizing. It's not a word that anybody's ever talked to me about, and I don't see this institution as anything other than a government agency that gets run for the benefit of the American public.
President Trump's nominee to run Social Security, Frank Bizignano, is testifying on and in front of the Senate Finance Committee about his plans for the agency. Joining me now to discuss what's at stake for Social Security in the coming years are Yahoo Finance's own Ben Werschel and Carrie Hannon. Ben, let's start with the policy. What are some of Trump's priorities for Social Security?
Sure thing. Good to be with you. So on the campaign trail, Trump offered a bit of a mixed message on Social Security. He was the candidate who was not going to touch Social Security, but he was also the candidate who was going to save it. So we can get into kind of why that's a contradiction. Since the election, as everyone knows, he's very much touched it. Elon Musk in particular and his Doge efforts have really integrated themselves into the Social Security system and made a lot of changes on things like phone service, field offices. They're trying to, in the name of government efficiency. The current acting commissioner is a guy named Leland Dudek, who has said that he's talked about even shutting down some agency functions as he stands off with judges on a bunch of legal issues. Frank Bizignano, as the clip you played there, has tried to offer a kind of more calming message so far today here in front of the Senate Finance Committee. He's presented himself as an efficiency expert, but also a customer service expert. His background is in payments. So he's trying to kind of offer a message that he wants the phone services to continue, which is a major issue for Social Security recipients, even as we're seeing all these changes there. The hearing is ongoing, but that's what his message has been so far.
And Carrie, Doge head Elon Musk has repeatedly accused Social Security of widespread fraud. So what are the source of those concerns?
Yeah, Brad, he has been obsessed with this idea that dead people are getting Social Security payments, which is simply all of the experts I have spoken to said this is absolutely untrue. There's absolutely no any facts to back this up. There's a very tiny percentage of Americans who are over 100 who do get Social Security payments, maybe 0.1%. It's a very tiny percentage. And he seems to have what I'm hearing is that he's completely misread the data systems and his team in Social Security. There's several different computer systems that work there that they're reading numbers from one database that is just not, these are numbers that they're pulling from people who had Social Security accounts from the beginning of time. So they're like 1 million people have had unique Social Security numbers. And because of when they passed away, when they died, their record of death was not recorded because there weren't electronic records back then. So there's a confusion over the data that they're misreading these. And in fact, that's not where there is obviously some missteps that do happen, but the majority of those are people who are overpaid based on inaccurate work records and so forth, and that has been being taken care of. But this material is reviewed over and over again, and the experts I speak to say that this is completely outlandish, what he says.
And so, Ben, there's also a funding crisis coming for Social Security.
For sure.
What do we need to know about that?
Yeah, so the Doge promise to a certain extent here is that there is this massive fraud and abuse in the system, which, as Carrie just laid out, there really isn't evidence for. And we've had a lot of evidence reporting in the last week even that Doge is getting there trying to find this fraud, and they're just not finding it. It was notable that Frank Bizignano embraced a current projection of 1% fraud, which is not nothing, but it's definitely not enough to change a fiscal trajectory, which has a lot of problems here. The Social Security Administration has laid out that by 2033 or 2035, depending on how they manage things, insolvency is there, and what that means is benefit cuts. If no action is taken, basically just the numbers don't add up. Whatever you do there, and it means it's about 79% of benefits would be paid out versus the 100% that are paid now. So that's a cut across everyone's Social Security checks and the benefits they receive. The question is how to solve this. History, there's a lot of examples from history. The problem is they are very unpopular. It's basically, do you increase payroll taxes or do you increase the retirement age? Nobody likes either of those things. The Doge promise here is that we're going to find all the ways to fraud to do this, but there's just no evidence that they're getting there yet. Either way, the fiscal trajectory is very clear that by next decade, there's going to be a problem with Social Security's funding.
And so, Carrie, you and I have talked at length about retirement and how important Social Security is within that calculus that so many households, every household runs essentially. So what is the significance of the cuts to Social Security funding or even privatizing Social Security, especially as it relates to seniors?
Yeah, Brad, you're right. 4 in 10 older Americans depend on Social Security for their sole income. I mean, this is a huge impact on people's lives and their ability to meet their costs. And when we look at some of the cuts to Social Security, we spoke recently about, I'm terribly concerned about this idea of people having to verify their identity if they want to start benefits, if they need to make changes in person, if they don't have access to a computer or don't have internet service. And this impacts seniors in rural areas in particular. And if they cut field offices, which they propose doing, it already takes over a month to get an appointment at an office in many cases. And this is a huge impact on seniors living in these areas who won't have access to their benefits and having controls of them. Then to shift quickly, and there are many other ones, but that's the one that's triggering me right now. The idea of privatization, which we just heard in the hearing, that never heard that, haven't discussed it. That's not really something coming up. Is probably I'm not sure, because this is something that's been bounced around for many years. This idea of taking what Social Security currently does is what's not being paid out to beneficiaries today, goes into a trust fund, and that money is invested in U.S. Treasury bonds and is guaranteed by the U.S. government. What the proposal, as I understand it, and the experts I've talked to say, is that they would take that portion and invest it in equities. And so there would be the upside of having that bump you can get from equities, correct? But then there's that risk if things go south and there are losses. And that is what we don't want to endanger retirees' future, solve their security payments. You don't want to endanger it with that kind of risk is the big concern here. Whether there are efficiencies by privatizing it, perhaps there might be, but it certainly ratchets up that whole idea of risk and a pack and money that people have paid into with their own earnings over their working years.
Ben and Carrie, thanks for teaming up on this one. Really appreciate the breakdown.
Thanks, Fred.
Bitcoin is on track to close the first quarter in the red. It's currently down around 7% year to date during 2025. The cryptocurrency falling from the all-time highs that we saw in the wake of President Trump's election victory in November. Our next guest says the pullbacks we've seen so far are not atypical. Here to discuss is Chris Klein, who's the COO and co-founder of Bitcoin IRA. Great to have you back here in studio with us, Chris. Yeah, just give us some context with what's happening with Bitcoin right now. Not atypical would still spell out something net positive, perhaps.
Yeah, absolutely. So obviously there's been a lot of short-term or near-term volatility in all markets. Bitcoin, through its halving cycles, this is about where we would expect it to be, with peaks coming later this year, about 450 to 550 days after the halving event that took place last April, which is where people are expecting somewhere between $150,000 to $200,000 of Bitcoin. But that last piece really speaks to this retirement crisis that we have in America. 2033, that pretty much means you and I just turned 40 last Friday, we probably won't see any Social Security in our lifetimes if the funding runs out.
Wow, happy belated birthday as well to you. And so what is the setup now going into the next 3 quarters of the year, especially knowing how this is an administration now that had campaigned on what it would be able to do, not just from a regulatory perspective and being more favorable to cryptocurrency, but also in building up strategic reserves and potentially purchasing. And it doesn't seem like purchasing is going to be the way of going about building that reserve up.
Well, it has to be net neutral. It was part of the decision that came through. But beyond just the United States, you see other nation states and sovereign countries coming out. Qatar announcing last week that they're planning on putting a reserve together. And individual U.S. states, Arizona and Texas, are first on the list, saying we're going to put some of this into our balanced budget, or to help balance our budget, taking kind of a page from the book of Michael Saylor and what he did over at MicroStrategy. But this has been a year where we've really accelerated the legitimacy. So Bitcoin has persevered through now 3 different administrations. Our platform's been through 2, and you're watching it go from anti-crypto, pro-crypto. It's showing that it's a train on a track that's headed to a direction of scarcity and store value that can't really be stopped.
And so with all of this in mind, how is this set up the price action for the other cryptocurrencies as well? Because that has been a larger kind of consideration around what this would mean a rising tide would lift all boats in the other altcoins or even the Ethereums of the world.
Absolutely. So there's this alt season that most people talk about post the peaks of Bitcoin. People will take their profits from Bitcoin and put it into alts. Last week, there was a big change at the SEC with the XRP dismissal of their case. And that was, I was quoted saying it felt like a lead weight was lifted off of the marketplace. And a lot of our platform users are really excited about that. It's interesting also to think about that even in these short-term aberrations, clients on our platform in just 4.5 short months since the election are celebrating 50 to 55% median gains on their in that short time period on their platforms or their retirements.
You have one of the other businesses that's annexed to President Donald Trump in World Liberty that's looking across stablecoins right now. Yeah. What is the broader cryptocurrency landscape's kind of own perspective on pushing forward more stable coins versus pushing forward some of the existing cryptos that are the market leaders?
That's a great question. It actually brings that, my Schoolhouse Rock tendency. It's kind of like a conjunction unction between the crypto markets and the traditional fiat markets. Stable coins have always been used as this bridge between the two. And obviously there's been times like Luna back in 2023 where there was serious problems with the ping on it, just like any other currency. But this regulatory guidance and clarity that we're getting from this new administration, I think that we're going to see a lot of positive come from that and a lot less of the bad actors and unscrupulous activity that took place in the past with stablecoins. But they're a part of the overall ecosystem.
What does this mean as well for the underlying technology and blockchain? Is it reaching even more of an acceptance, not even just an acceptance points, but a utilization point across all of the different measurements beyond finance and the industry there in financial services that were seen as some of the earliest benefiters of the underlying technology?
Absolutely. I think it's become more than just the buzzword. I remember back when we started this in 2016, and then in 18, it was all about IBM and these groups were a blockchain-friendly company.
Long Island Nice Tea changed their name to Long Island Blockchain.
Exactly. And they still kept their prices down.
Yeah, they did, somehow. Yeah. But, I mean, that goes to show the technological shift that a lot of those companies...
And AI has become the new buzzword. I'm excited. There's the Bitcoin conference in Las Vegas in May. Okay. And I'm excited to go and just spend time on the floor, seeing what kind of projects people are working on. There's been these waves of adoption into blockchain technology. And I think we're going to see it further, perhaps even from the federal and state governments using it to do things like audit the Fed or audit tax dollars going in and out and spend it in expenditures. So it should be a really exciting year ahead as we see this accelerated adoption of these things.
All right, there's an ETF conference happening in Vegas right now. There have already been several other conferences this year. It seems like it's the new mecca for just all of these.
Last year we were in Nashville, and
it
was great. But Vegas is closer for me from Los Angeles.
Oh, that's good. Shorter flight. Chris, thanks so much.
Hey, thanks for having me.
Coming up, housing hurdles. We talk about the latest housing data and the rate that you can expect to pay for a mortgage in the coming year. Stay tuned. The National Association of Realtors just announced a change to its rules around listing options for real estate agents that it says will allow for more choices for consumers. And here to break down what's changed, we've got our very own Claire Boston. Claire, what has changed?
Hi, Brad. So this is real breaking news, just came in a few minutes ago, but this is about what is called the Clear Cooperation Policy, and this governs how, if you are a seller, you have to list and market your homes. Traditionally, there are these things called multiple listing services. That's kind of what you see if you're searching on Zillow. That disseminates a lot of information about the home you have for sale. But there are some sellers who, for whatever reason, maybe don't want to share that they have a home to sell to the whole world. And old policy said that they had to list or they had to market their homes on these MLSs very quickly. But we're getting some changes to these rules and a new rule that says basically under certain circumstances, they can delay marketing of their homes. And the reasoning of this is maybe they don't want to tell everyone. Maybe the realtor has a couple of people in mind for a sale and they want to do it privately. The National Association of Realtors is saying this is going to give consumers more flexibility.
Yeah, we have a comment here from the president of the National Association of Realtors, Kevin Sears, who essentially said the National Association of Realtors is continuously reviewing some of these multiple listing services policies here and ultimately trying to make sure that they undertook this conversation comprehensive review of the CCP Clear Cooperation Policy as part of those efforts to ensure home sellers and buyers have the information and flexibility, and that flexibility getting a little bit more clarity here with this announcement. You also have a story out today that's actually about how new rules in general meant future, quote, secret listings. So what does this adjustment mean for that pocket of the market?
Right, so we're talking about secret listings or pocket listings. These are those homes that are not listed broadly on the MLS. These new rules are designed to give sellers a little bit more flexibility. It would allow for those listings to remain and to give sellers options to delay their listings. And it's really, they say it's really about choice here. This rule had created a lot of controversy in the industry. Some realtors really liked it, some hated it. A lot of the realtors were saying, we want to give our sellers choices, but we also want to make sure that homes are really broadly available. There could be fair housing concerns, for example, with not listing homes broadly. And so they're saying will give sellers more flexibility while also still, preserving that information to eventually be on the MLS.
Claire, thanks so much for breaking this down for us. Some breaking news here today on the front. We've got some fresh housing data out this morning. First, the S&P CoreLogic Case-Shiller Index showed home prices nationally rose 4.1% from the year prior in January. And new home sales for February up 1.8% month over month after seeing a dip in January due to bad weather. That's according to the U.S. Census data. So what does all this data tell us about the health of the housing market? Joining me now, we've got Skylar Olson, who's the Zillow Group chief economist. Let's just start there. What does the kind of broad paintbrush of this data really tell us about the housing market?
Yeah, the Case-Shiller numbers out today capturing accelerating home price growth over January really speaks to there being enough buyers over a housing market that has very limited inventory and fewer new listings hitting the market than traditional or normal. I do want to remark, though, that acceleration that we saw in these numbers in January may not last. Zillow's own numbers did see a significant deceleration from January into February. Yahoo Finance, y'all are, of course, tracking the stock market. Some of that correction could remove from those enough buyers' ability to move forward and fund those down payments with stock portfolios. We also are noticing inventory starting to fill up. So buyers hesitating on these high prices that continue to grow without price cuts. New home sales was expected because of the weather change, right? Weather is pretty impactful to people's ability to go search out and explore homes, and so slow down those sales, though the return in the more recent month, from clearing up that dynamic. I think moving forward, builders are still able to buy down points more significantly for buyers and achieve that greater affordability.
And so I wonder how you're kind of running the math around where there is strength in either the existing home side or the new home side, and kind of, I guess, comparing the two against one another.
Yeah, let's do it because they are related. Let's tackle new home sales or construction first. As have been the case for previous months, leading the charge in this recovery is the South and the Midwest. These are markets where we've been able to better keep up with growing populations simply because of new construction. If you think about what that does at a time when the inventory or new listings from existing owners is so low, new construction allows that owner to at least move up into a higher option. Other markets that don't have that new construction are still incredibly locked in to those lower mortgage rates because they don't have that release valve for those move up buyers. So if we think of places like that, that's the Northeast, that's the Pacific Northwest. I used to say California when I gave an example of places that are significantly locked up and still holding onto those listings. But over the past year, California, including, move a little bit more into the Southwest, Phoenix are actually up significantly over the year in terms of new listing activity. So things are still changing a bit. But ultimately, what we see across the country is a set of buyers markets. Think the South, think Texas, places where we were able to build, places where people are less locked in because we have newer, recent homeowners in those spaces. Those are more your buyers markets. These are places where we see high levels of price cuts. Nationally, we saw record numbers of listings getting a price cut in February. Remember, that speaks to us expecting deceleration in home prices moving forward. We also saw time on market lengthen significantly, and this would be even more true in a buyer's market. We're now only 4 days shorter than pre-pandemic. We're expecting that kind of softer competition to remain moving forward. This is good for buyers that are ready, right? They already have their savings. Maybe they're less concerned about economic softness or any job developments, and now they can jump into the market at newer, lower mortgage rates.
You know, we only got about 30 seconds here, but if you were to offer any tips for those who are getting their spring home buying season mindset in order, getting out there, checking out listings, what would those tips be?
Yeah, first and foremost, shop by mortgage rate, right? You're going to have these brief windows of opportunity when mortgage rates are low. We cannot guarantee they will stay where they are. There are lots of affordability calculators out there, but Zillow's buyability tool allows you to shop by mortgage rates so you see what's affordable while you're shopping as it changes, because mortgage rates most certainly will.
Skylar, thanks so much. Very valuable tip and insight there. We appreciate it.
Thank you. Take care.
Coming up, if you're looking for a new job, we have tips for showcasing your skills. That's coming up next on Yahoo Finance. According to LinkedIn, 21% of job seekers worry they don't have the skills it takes to keep up with the future. For workers who want to maximize their skills, we've got Andrew McCaskill, LinkedIn career expert, in studio with us. Andrew, LinkedIn found the most in-demand skills is AI literacy based right now. So, I mean, what does this even mean right now? We're just kind of slapping AI and you need to have that on your resume in some form or another, seemingly on everything. But what does this actually mean in practice?
What it actually means in practice is that it is a tough job market out there, right? We are looking at numbers like we haven't seen in a long time, and so many of the numbers aren't taking into consideration all of the numbers from the government work as well, right? So it's really competitive. I think that AI literacy is going to be at the top of that list. But it's also other parts on that list is like you're going to need it for work, but you're also going to need to be thinking about how do all of these other things play into it. So you've got engineering, you've got all of these other pieces of work, but there's so many other things that play into it. Like the other parts of the list that we saw, like little things that we didn't seemingly like they wouldn't match up, right. But these other skills that are on the rise too, it really looks at across the bow. All those things connect to each other.
We saw a study from McKinsey that actually found a majority of employees think that AI will transform their work, and many are already seeing that and they're using it at work. How do you separate yourself from the rest of the pack when it comes to utilizing AI in your day in, day out tasks that you need to get through?
Yeah, you got to think about the actual skills on a day-to-day basis, right? Like that you will need some AI literacy, you will need AI competency, but what are the other things that contribute to that? Mm-hmm. Adaptability is on the top of that skills on the rise list, right? You've got to be able to pivot and not panic, right? The other things that are on that list are things that are conflict mitigation. So there's all these things that are happening in the world right now. You need to be able to be calm and help people get back to the day-to-day work. So all of those things really matter. The skills that are necessary for that, the flip of that too is that you also have the opportunity to say, hey, I'm in the market right now. How do I think about this? What do I need to actually get hired? Mm-hmm. And one of the things I think is really important as you start to think about, okay, where do I connect those dots, is start looking at these job matching tools that we have, right? Like you can go on and you can take a look at, here are all of the jobs that I am truly qualified for. That way you're not just out there taking on anything. You're not wasting your time. The other good thing too is that LinkedIn will now, all of these skills that are most in-demand skills, there's a LinkedIn learning course that is free that you can take, that you can bone up on every single one of those skills, right? That's where we're saying now you can also use our job match tool. You can go in, put all of your information in there. It will show you how good you are a match for these jobs. It'll show you your strengths as well as your weaknesses, so you can go at this with a strategy, because you will need a strategy in this current market to land that job.
That's so key. How can workers make sure that their skills stand out when applying for a new job?
You've got to take a look at how you're talking about your skills on both your resume and your LinkedIn profile. Our recruiters, 50% of them are using skills to source talent, not where you graduated from college or university, not even where you used to work. And so you've got to make sure your skills stand out. And it's not just standing out on their profile. In your actions on platform, you've got to talk about your skills in action so people can actually see the impact of the work. It's a full-scale plan to look for a job right now, because you are absolutely competing against way more people than you might think.
Andrew, thanks so much for breaking this down, setting people up with some tips in order to make sure that they have a successful job search process out there. And happy birthday.
Thank you, sir. Thanks
so much for joining us on your special day. We appreciate it. Coming up, as we enter into spring, it's time to spring clean your finances. We'll discuss strategies for paying down your debt after the break. A programming note: in this week's episode of Decoding Retirement, host Bob Powell speaks with the founder of a financial education platform geared towards people over the age of 50 about the triple-decker club sandwich generation, aka the increasing number of households with people caring for both children and aging parents.
This is the first time in history that 4 and 5 generations are living contemporaneously. And that's crazy. That affects our housing, that affects our familial relationships, and it's a tremendous opportunity to learn from grandparents in a way that maybe you and I did not have that opportunity by the time we met our grandparents. Maybe they had passed, but maybe they were older. So the triple-decker club sandwich generation is my joke, not only about my cohort, but also my own life, as I have grandchildren and a 97-year-old mother, and there's nothing wrong with her.
You can catch episodes of Decoding Retirement Tuesdays, 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. In a new survey from Debt.com, it finds 1 in 3 Americans say they rely on credit cards to make ends meet. 32% have maxed out their credit cards, 63% carry a credit card balance, and more than 1 in 5 owe over $10,000. All week on Wealth, heading into the second quarter of the year, we're helping you spring clean your finances, and today's focus is evaluating your debt strategies. Here to help is Nick Holman, who is the Director of Financial Planning at Betterment. Nick, good to have you here with us. Let me just get your thoughts on that survey and those findings and what it's ultimately saying about the state of Americans finding themselves in right now with regard to debt and credit cards.
Yeah, first off, thanks for having me back. The data's out, delinquencies are up, and there's over $1.2 trillion in credit card debt. We're seeing a lot of investors getting really nervous about investing in the stock market, and instead they're fleeing to cash. And what I would argue is many of those investors that are fleeing to cash would actually be better served if they take those funds and use them to pay down credit card debt instead of sitting in a cash account that might not be earning nearly as much interest as they're being charged on their credit cards.
How do you decide what kind of debt you should pay off right now and what strategy you should use?
Yeah, so I'm a math guy, I'm a numbers guy. I prefer what's called the debt avalanche, which if you're not familiar with it, it means that you prioritize paying off debt with the highest interest rate first. But we take it even a step further. So map out all of your debts, list out their interest rates. If you have any debt right now that has an interest rate above 8%, given where the market is, given where the Fed is, right now that 8% cutoff is what we're telling clients. If you have rates above 8%, pay that off before you do almost any investing.
So what about refinancing your debt? Is now a good time to do that?
For most clients, I'd say no. If you look at what the market's predicting, they're pricing in roughly 2 to 3 more rate cuts by the Fed before the end of the year. So if you're on the bubble about refinancing, I'd argue maybe sit tight. Hopefully those rates will come down 2 to 3 more times, even more than where they are right now. And that's when you should take the opportunity to refinance any high interest debt.
And so with what we were talking about in these survey findings, the number of Americans that are actually using credit, perhaps just as a bridge in order to make sure that they can get through some of the paycheck to paycheck pressures that they may be feeling. How can you ultimately, once you've started to pay down some of the debt, make sure that you're also setting up a better routine for not needing to tap credit as much?
Yeah, I saw just a headline recently where food delivery services are now offering buy now, pay later. So I think that really signals that some buyers out there are having a tough time making ends meet or living paycheck to paycheck. Sometimes it's not going to be some easy, simple answer, but taking a step back, prioritizing your goals, setting a budget that starts with your savings goals first, as opposed to what your spending goals are, that'll help make sure your priorities are aligned. And then tracking your funds on a monthly basis as well, using a budgeting app. There's lots of these strategies that it's nothing necessarily new, but I would say coming into the new year, people are fresh off New Year's resolutions. Seasonality isn't really a thing with debt, but tax season is. And so if you're one of the 120 million taxpayers that's expected to get a tax refund, don't squander that influx in cash. Consider using that as a great way to jumpstart your new goals to pay down some of that credit card debt.
And while you're looking across your debt, how do you avoid some of the common pitfalls? And what are some of those frequent pitfalls that you've seen?
Yeah, I'm not anti-debt, just to be clear. I myself have like 10 credit cards. I love optimizing and getting as much value and points as you can. But we see a lot of clients really get tripped up on that. So if you are starting to go into the credit card game and trying to maximize points and miles and those types of things, one thing that you need to make sure of is look at credit cards that have a downgrade path, or sometimes it's called a product change. Google that term if you're thinking about applying for a card. What that means is you can sign up for the card, take advantage of any sign-up bonuses or great rewards that they have, but it gives you an exit path. So if that card, for whatever reason, no longer makes sense or you can't justify the high annual fee that it has, you can downgrade or do a product change to maybe a lower fee or even a no-fee credit card. And that's going to make sure that you're not living for the short-term points and sacrificing your long-term financial future.
Nick, thanks so much for joining us. Really appreciate it.
Thank you.
Let's do a final check of the markets here. We're taking a look at the major averages, which you've had flowing across the bottom of your screen on our ticker. We have turned mixed. The Dow is flat, just barely to the downside. S&P 500 flat to the upside. And the NASDAQ holding on to gains of 0.25%. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.